the current political rhetoric. But in any event, what you can see is that this is not a party issue at all. If you look at the extreme deficit at the end 2010, most of that is not in fact caused by extra government spending. It's caused by the depth of the recession and the magnitude. Remember, we're paying unemployment benefits to all those people who were unemployed not for 13 months but for 4 years. And so if you take out the effect of the recession on government revenue and government expenditures, the Obama administration is spending more than it gets, exactly as much as the first Bush administration, the second Bush administration, all of the administrations going back. And you could argue that the Clinton surplus was essentially due to the tech bubble and the massive amount of capital gains that were taxed by the federal government in that euphoric moment of excess. So I want to stress that our problem, underneath all the rest of this, is that there is no viable political process which can have a grown-up dialogue about how to stop this happening. You cannot say we'll reduce the taxes and reduce the spending, because the reducing of the taxes sometimes, though not often, happens, and the reducing of the spending never happens. And this has been true for decades, not just for the last 2 or 3 years. And this picture you could do again for the states, you could do it for cities, you could do it for municipalities. Our country faces a short-term problem with the recession and the volatility and all of the things we've just discussed. It faces a fundamental problem of being grown up and mature in understanding that you can't have more than you've got for very long. The borrowing, whether it's by households consuming more than their income or by the government promising you all sorts of benefits without being willing to tax you for it, this cannot go on. And we are slowly approaching a time when this political process will actually crack, and we will start to suffer the fate of those pigs that we made so much humor about a few minutes ago. What is the difference between the budgetary policy of the United States and that of Greece?
So George, let's start to bring this home, and let's talk a little bit about what this all means as it relates to how people invest.
Yes. In the end, as Russell says, I'm not running for public office, and so you don't have to listen to my speeches. But we are managing your money, and we have the duty to preserve the principle and try and earn returns. In the environment that I have described, it's clear that you could expect volatility, not just for the next few quarters, but for many years to come. It's an up and down market. And that volatility can be a trap for the unwary, but it's an opportunity for active, prudent investors. And we want to make 2 points, Russell and I. First, and this is very fundamental, the old notions you've held, you should be a buy and hold investor. Oh, you know, your Merrill Lynch broker tells you put 60% in stocks, 40% in bonds, and just sit there and you'll become happy, wealthy, and wise. This simply doesn't work. In the environment in which we find ourselves, you get absolutely unacceptable volatility. And so what you need to do is some very basic financial planning. I don't mean the 40-page document, but some very clear thinking. We'll explain in a moment what that means. And then manage assets actively, which means when times change, you change, actively to take advantage of opportunities and walk away from some of the larger risks. If you think about buy and hold, this is a picture of the total return on the S&P 500 from 1995 to the present. What's total return? It's the sum of dividends and capital gains. And what you can see is that all the return in holding the S&P 500 happened between 1995 and 2000. Since then, essentially, a stock market investor in our country has earned nothing, and on the way has had some massive ups and downs, absolutely massive ups and downs. This notion of buy and hold not working hasn't worked across a broad class of assets. All these beautiful colored lines are different kinds of assets. There's a little box on the lower left. The only thing that seems to have been a good investment is gold, which is the sort of magenta line that keeps climbing from the lower left to the upper right. Everything else has essentially returned nothing. The dotted line is bonds, treasury bonds, and they've only returned things because interest rates were driven down by the government in the anti-recession policy. We've already discussed that. That's reached the end. There will be losses and not gains on treasury bonds hereafter. So you can say, well, at least buy and hold worked for gold. Sadly, it didn't even work for gold. If you take the long view, you will see that gold prices reached their peak in 1980. In nominal terms, they've recovered that peak. In inflation-adjusted terms, they still haven't. No asset that you can buy is worth holding in a buy and hold philosophy of investing. You have to accept that there are enormous volatilities which seen on these pictures, other things from turning on the television. You need to move with these volatilities. You need to anticipate them and try and protect yourself from the downside in negative movements, and to take advantage of, as I said, when things are cheap and sell when they're expensive. The only sensible way to manage investments is in a mildly active way. I'm not telling you to be a day trader and sit in front of the screen, but I am saying that there are big movements. We've discussed the causes and so on. You need to think them through.
So I guess that goes without saying you're an active manager.
Yes.
So sum it up for our audience in a couple of statements and what you're doing today in portfolios and how you're investing for.
Sure. So what we've got here is just some of the things we've done. When we believed Asian growth was accelerating, we overweighted industrial raw materials and energy. Slowing domestic growth, as we anticipated the tightening of the recession, we reduced our domestic stock investments, but we moved them into global blue chips, because these blue chip companies are much more resilient, less likely to be damaged by recession, and have the advantage of global scale, and they can take advantage of growth outside the United States where there are still business opportunities.
And would these typically be a lot of companies that had a lot of cash and not debt?
Exactly. That's exactly right. These are also companies that had cash and not debt. We anticipated the crisis in the euro. In fact, I was in London trapped under that volcano and couldn't come back.
Right, you were.
Last year. And we pulled a lot of our money out of euros in advance of this event. Deteriorating municipal finances, we have been worried about the muni sector for some time. At a time when people were enthusiastic, we were telling everyone, think of taxable debt, it's better. Now people are going in exactly the opposite direction. Even though not every state will default and not every city will default, spreads are rising and rising on munis. We're approaching a point of bargains. So even with something like munis, sometimes it's better to be taxable, and sometimes you want to add to the exposure because others are running away.
Talk to me a little bit, George. One of the things, some of the comments on the last page were traditional investments that most people know. Is there a place for alternative investments in a portfolio?
Yes, that's a good question.
Can you describe what an alternative investment is when you
of course
discuss that?
So conventional investments that people think of all the time are stocks and bonds. And alternative investments are essentially pretty much everything else that embraces commodities, that embraces real estate, and it embraces hedge funds, which are essentially investment vehicles that speculate on movements in currencies, changes in credit ratings of emerging market debt, and so forth, of which there has been a great deal. Now, people have said, oh, that's very risky, in speculating on changes in credit rating of Indonesia or something like that, or commercial real estate. That does turn out to be risky, and commodities and so forth. So these things are actually not so much risky as unfamiliar, and many people make the mistake of confusing what's unfamiliar with what's risky and what's familiar with what's safe. So what we have on this picture, on this chart, is a calculation of two hypothetical portfolios. The one on the left is a traditional portfolio, 30% bonds, 70% equities, and the one on the right has 40% equities, 30% bonds, and 30% in a mix of alternative investments, 60% in hedge funds, 20% in commercial real estate, and 20% in commodities. And again, you can talk to us offline, and we'll explain all of this in greater length. And it looks at the hypothetical return of these two strategies between 2000 and 2010. And what you can see is neither of these portfolios distinguished themselves particularly. It was a very difficult period. But the conventional one, had it simply been held for that period, would have returned about 2.4% with a standard deviation, a measure of how much up and down there was, of nearly 13%. The other one, with these strange assets in it that everyone thinks are risky, would have had nearly double the return with a lot less standard deviation. And if you look at the next picture, this is a more compelling way of looking at it. It looks at the downside, not on gains, but on losses during that period. And the heading on the picture is drawdown. You see, the sophisticated investor no longer talks about losses. They talk about drawdown. You see how much better it is to have your money drawn down than to have lost it. That's our contribution, the contribution of the financial industry to the English language. But if you look at the picture itself, the red line is the S&P 500 over this period, 2005 to 2010, whereas the black line, the one that's the black line, is a portfolio rather like the one on the previous page, this bundle of alternatives. Both of them lost money, especially in 2008. You can see, however, that the esoteric alternative investment strategy lost less than 10%. The S&P lost more than 50%. The other lines are a bond index. The yellow is the Barclays bond index. Obviously, since interest rates were forced down dramatically by the Fed, just holding these bonds caused capital gains as the interest rates fell. But if you think of long-term investment strategies and you compare the S&P with these hedge funds, what you can see is that while they may be unfamiliar, they have a record, and it's longer than the one that's shown here, of being better protection against downside. So everyone should think about these things. But you have to be very careful in this context.
So active management is obviously something that you embrace and that you are performing in Nevada State Investment Services. Is that the answer to all, George? Is it the safest way to? Is it the safe way to invest, or should one use caution?
Well, I think that I've conveyed clearly the message that in the environment in which we find ourselves, you don't have any choice but to be active. The question is, how do you do it? And there you have to be very careful, and we're very nervous folks when it comes to this. We are active because we have to, not because we wake up in the mornings and want to trade things. The fundamental point is what's in front of you here. Every investment is a gamble on something happening in the future. Every investment is a prediction about the future, whether you're buying an apartment building and you predict that people will want to occupy it, or you invest in a company because you think it will prosper as its products sell. Every investment is by its nature a gamble on the future, and nobody can predict the future accurately. You can get a pretty good feel for things. You can get a pretty good feel for what's probably going to do well and probably badly. You may not be right on the magnitudes, and you'll certainly have a great deal of difficulty on the timing. If you think back to my remarks on duration, on interest rates going up, we shortened the duration of all our fixed income portfolios 12 months ago, and the payoff happened 2 months ago. So for 10 months, we sat with these portfolios which were earning less than benchmark indexes. The yields on our fixed income were lower, and people said to us, how come we're only earning X on your bond portfolio, whereas the market's paying Y? And we told our story, rates are going to go up. We couldn't tell you the Friday on which this was going to happen, but we knew it was going to happen. So nobody can predict the future accurately. Next point, risks affect each investor differently. If you are retired and you need cash flow, the biggest risk to you is whether your cash flow is going to be interrupted. If I gave you an investment which was going to make an awful lot of money between 10 and 20 years from now, but it was enormously volatile with very uncertain cash flows, for you that would be a terribly risky investment. For someone who's 30 years old and isn't going to cash in this money for another 30 years, it's a wonderful investment. They don't need it in the meantime. So for them, it's not risky. They're only concerned with that terminal value. For someone who's interested in the intervening values or in the cash flows, it's terribly risky. So there isn't one concept of risk. A person who's retired or a few years from retirement with $1 million of savings is in a very different position than a 30-year-old tech millionaire who's just sold his company for $50 million. And so what one thinks is risky will not be there for the other. So you don't even have one view of risk. The third point, the one we're conscious of in our office here all the time, even the cleverest people make mistakes. If you think emerging markets are good, invest something in emerging markets. Don't take all your money and put it there. And if you think they're bad, don't take all your money out, because you could be wrong. So what we do is we move these portfolios, but we don't move them from one extreme